I invested into 3 different asset classes over a period of 3 months, and my best returns have been over 30% and my worst below 2%. In my previous video, I shared that I was using my own funds to test selling options. Similarly, in this video, I'm also using my own funds to test different asset classes over a period of time to see how they perform. And the 3 asset classes are cash management products, S-REITs and equities. Now, I have different buckets of funds. Most of them I have no immediate use for. So it's for long-term investments. Some of them I have immediate use in the short term. For this video, I'm mainly using funds that I have no immediate use for. And my goal is to squeeze every cent possible out of every dollar I own. What I believe is that for funds that I have no immediate use for, I will take on slightly higher risk. For funds that I have immediate use, lower risk. And before I share with you about the different asset class, let's talk about the platforms that I use. There are 5 main platforms that I'm using. First is Endowus, followed by Syfe, StashAway, Moomoo, and Chocolate Finance. So, did I research into these companies? No. Did I read reviews about them? Yes. And I even spoke to people about what they think about these platforms. And do I trust them? I suppose I do because they are licensed by MAS, but that is all I did. With that, let's go into the first asset class, cash management products. I've invested into cash management products before, and all I remember is that there are low returns, about 1 to 2%. So what exactly is cash management products? Let me give you the AI definition. A cash management products invests your idle cash into low-risk investments to earn better returns while keeping your money easily accessible. These products invest in low-risk assets such as money market funds, government securities, and high-quality corporate bonds. So there you have it. For this asset class, I invested into 2 different currencies, SGD and USD. Now for SGD, the typical returns are between 1 to 2%. But for USD, the returns can be between 3 to 4%. Now to my understanding, the USD is higher because US has a higher interest rate. But at the same time, I'm also taking on forex risk because if there's a huge change in the US to SGD rates, I could either be earning a lot more or I could even go to the point of losing money. So with that, let me give you the numbers for my cash management products. First, let's talk about Syfe. I invested about 7,000 into Flexi SGD, and the current value now, as of today, is about $7,022. The projected returns back then, before I invest, was about 1.7%. Now, based on today's value, the actual returns is 1.29%. As for Chocolate Finance, I invested into their Boost with USD. The invested amount was 63,750 SGD. Today's value is at 65,270 SGD. The projected returns back then was 3.92%, but based on today's value, the actual returns is 10%. So you can see the difference in return. Syfe SGD was at about 1.29%, but for Chocolate's Boost with USD, it's 10%. So why 10%? Isn't the projected at 3.92? It's because when I invested with the Boost with USD, the exchange rate then was 1.275%. Today it's at about 1.293%, which is a 180 pips difference. That's why earlier when I said there's a difference in the exchange rate, you either earn a lot or you lose money. So at 180 pips, my return was 10%. But conversely, if USD now was stronger, then I may even lose money. So that is the risk that I'm willing to take for about a 4% return. So that's for cash management products. For now, Boost with USD is doing much better because the exchange rate is in my favor. Let's now talk about S-REITs. I've always heard about S-REITs and how good it is. I've always heard people say that they can get returns of 5%. But I've never ever tried S-REIT before. I just hear about it and I forgot about it. So for this particular case, I intentionally invested into S-REITs. And my understanding about S-REITs is that it's sort of like a share. It does have a price that goes up and down, but the value lies in the dividend returns that it gives to you. So let me give you the numbers. For S-REITs, I chose the Moomoo platform, and the S-REIT that I chose was Frasers Centrepoint, J69U REIT. I invested $10,032. The current value is $9,856. Now the dividend that I received was $269.99. The projected return back then was 5%, but based on today's value and the dividend that I received, my returns is at 1.15%. Now, you may have noticed why the drop in the current day's value before dividend. It's because when I bought it, it was at $2.28. As of today, it's $2.24. That's why the drop. But with the dividend injected in, I did not make a loss. However, as you see, the return is only 1.12%. I don't know, it kind of feels like a mutual funds to me, where there's a price and you get dividends. And if the price of that REITs drop, I could lose money. But as of now, it's 1.12%, so it's not the 5% that I thought it was. Now, why did I choose Frasers Centrepoint? To be really honest, I agak-agak one. I reviewed some of the things that influencers shared about. I read about it a bit. I think I like Frasers. I know about their malls. I look at the returns, so I chose them. Did I do a lot of research? The answer is no. To be really clear, I'm basing my choice off the comments of other people, less so on my own research. Let's talk about the last asset class, equities. Let me first be clear. I am not the type that likes to read charts or study about PE ratios and things like that. As you can see about S-REITs, I didn't even study a lot about it. So that is not my style. I don't like it, I hate it, it's not my cup of tea. So therefore, the way I go about is to use platforms like Endowus and let them decide what they are going to invest into. For me, I just need to set my risk appetite. And so let me share with you the numbers. First off is Endowus. I selected high risk, 100% equity. The invested amount was $1,000. The current value is at $1,079. The projected returns back then was 7.78%, but as of today, the returns is at 36.68%. Can you believe that? 36%. It's because I set my risk to high and everything was into equities. But I must say that the last 2 years has been a good bull run, and also it's only been 3 months in. So 36% is not really representative of what it could be. I expect this number to come down way lower. But like I said, I'm a low risk investor. Though I set everything into equity, the amount invested was only $1,000. That is something that I could stomach. Now let's talk about Syfe. Similarly, 100% equity, invested amount is also at $1,000. At today's value is $1,075. The projected return back then was 9.7%, but the actual returns is 34.41%. So very comparable to Endowus. Finally, we have StashAway. The settings I could set was high, but maximum was 92.8% for equities. Again, I only invested $1,000. As of today, the value is $1,080. The projected return back then was 9.5%, but actual returns is at 37.08%. So the winner here is StashAway, but they are all very comparable at over 35%. Again, like I said, it's early days, it's only been 3 months. This is not representative of what 100% equities can be. The numbers will definitely drop. To sum up, high-risk portfolio are doing extremely well, but it cannot be over the long run. It's not feasible to stay at that rate. And it's not an issue for me to invest into this high-risk instrument because it only represents a very small percentage of this particular portfolio. I wouldn't have been able to stomach that kind of risk if I use a majority of my portfolio into these high-risk assets. So I'm only doing this to test and monitor the returns over a period of time. As for the lower risk investment, each one serves a different purpose. For the USD cash management products, Boost with USD, I'm willing to take on forex risk in exchange for better returns because I have no immediate use for those funds. On the other hand, for SGD cash management products, Syfe Flexi SGD, I'm okay to accept about 1+ return because I have immediate use for the funds soon. As for S-REITs, it's a little bit disappointing right now at about 1+%. 3 months of data is practically negligible in terms of investments. It'll be more interesting to see what happens after 1 year, 3 years, or even 5 years later. So my plan is very simple. Keep the funds invested, keep monitoring and tracking the returns, and sharing the results with you guys publicly. If you yourself are using any of these platforms into this specific asset class, do let me know what your returns are. I'll be keen to do a comparison with you. And if you're interested in this type of experiments where I use my own funds to invest into different assets class and to share with you the returns, do subscribe and like.